Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back for me, I guess. Sorry I was out last week. Tried to do a video last week, but just could not get it to process and upload. I was traveling all over the place in California last week with my family, going to really mastermind meetings and business meetings out there, which was good. Definitely fun and enjoyable to have them along with me in that kind of adventure for a week. Which was great. But it's good to be back and good to be in a rhythm. And I thankfully have nothing planned basically for the rest of the entire year, which is good to be past a lot of like meetings and events and stuff like that, which, are behind me. So good to go. But also, you know how it is when you get home from vacation, you almost kind of like need a break from traveling. So good to get back into it this week. We had a lot of activity today, trying to get back into a lot of earnings trades. So we'll start off the day, obviously, with what we did early in the morning today. Early in the morning, we got into our first new position for September for EFA with this Iron Butterfly centered at 66, and then bought options outside on either end really, really cheap. Now, again, you notice we didn't go as far out on the call side, only about 4 strikes wide. On the put side, we went about 5 strikes. Going 4 strikes wide on the call side, we could still buy options for 3 cents to get really, really cheap protection. So this is effectively like a straddle, basically is what we're doing, but buying really, really cheap protection on either end. And so again, this is a first position that we have for EFA in September. It's had a nice little run up here. I think it's going to kind of stall here just a little bit, but implied volatility is still a little bit elevated. It's not as high as it was before, just like 3 weeks ago when we got into our first position. But we still like it, and we still want to, keep building a position here, and just helps diversify out the rest of the portfolio. We also have SMH. So SMH, we closed out of one of our August positions, which is well beyond the 50% profit target that we generally have for strangles. Again, if you're wondering, like, why are we holding these things just a little bit longer, it's because of the profit matrix. What we've seen in the profit matrix report is that when we hold some of these positions just a little bit longer, we actually end up getting higher CAGRs at the end of longer periods. So we sacrifice win rate just a little bit, but I think it's more than offset by the fact that we're generally collecting a little bit more money. So with SMH, though, we do still have a bunch of strangles that we have kind of working and rolling in SMH, both in September and in August. So we'll just keep kind of chipping away at these. The August position that we have left is now got a put that's really far out of the money, so we'll probably consider moving that closer, but not until next week. So we really want to wait until we actually get into the August expiration period before we actually move that put closer. But like I said, if we get to next week and SMH remains high or elevated, we're starting to get a little bit challenged on our 89 calls that we have left, then we might move this short put up and reset the delta. So it was originally a 15 delta, so we'll probably move it up. Like if we were to move it up today, we'd move it up to around 82 or so and kind of reset that and move that closer. But again, in my opinion, I don't think we should do that until we get into the August expiration period, like August month, like calendar days of the August monthly cycle. All right, so that pretty much takes care of SMH for now. Also got into a new position in the Qs. We're trying to squeeze one more strangle in here for the August expiration month. We start getting around 20 days. It's not the most optimal time to be selling strangles based on our profit matrix research and all of our back testing. So we're going to try to squeeze one more in here, around 25 days to go until expiration. We're selling basically the 15 deltas again. So the 149 calls, the 138 puts. Again, if you're an iron condor trader or you're trading in a risk-defined account, you want to be using the trade comments as guidance for when to do that. And this is our third laddered position in the Qs for the month of August. So we'll continue to now manage the month of August, leave on what we have on for the Qs, and then start building out September probably at the end of this week. So you can see in August, we've got the 127 puts, we've got the 130 puts, we've got the 138 puts now. We're just continuing to build that ladder. And on the top side, you can see we've built the ladder 145, 148, 149, etc. So as the market has moved, so have our strikes. So if we go to the Qs again, you can see we started building this down here, right? So we had strikes here and here roughly, and then here and here, right? We're just continuing to move this thing higher and higher, moving with the market. And so that's what we'll continue to do. That's what works out. So implied volatility is decent right now in the Qs. It's not insanely high like some of our original entries, but we want to continue with this laddering technique and just getting a lot of trades on because we know that it works really, really well. All right, so earnings trades, as far as they go, first of all, if you're a new member, obviously at Option Alpha, we had a lot of new people join last week. If you're a new member at Option Alpha, we do send out all of our earnings alerts very close to the end of the day. I try to start filling them about 30 minutes before the end of the day. You can always check out our earnings calendar to see what we are looking at and what the expected moves are and when companies announce. The biggest thing for me, though, is that when you're looking at a company that might announce is to double check that implied volatility, because what we want is we want super, super high implied volatility. So for example, like we tried to get into a trade in McDonald's, just didn't get filled. McDonald's has super, super high implied volatility, something like APC, which I believe they also announced today after the close. They did not have high implied volatility. So it was like 48, 49. That's not super high implied volatility for an earnings trade. So even though it's on our calendar to look at, you always want to double check that implied volatility just to make sure that's got, some high rankings, right? Because we want the really, really low hanging fruit. So like Google, high implied volatility, 77 heading into earnings, one of the highest readings that we've seen kind of in the last like 4 earnings cycles for Google. And looks like it might end up working out pretty well. We also did the earnings trades on weekly contracts. So again, if we ever have a weekly trade, we will specify in the alert the exact date of the weekly expiration. So there's no confusion there. In this case, it's the 728 contracts, which are the frontmost weekly contracts that expired this Friday. Now with Google, we knew that the expected move was about $35 or so. So that's about how far we went out from the at the money strikes. We went out about $40 and trying to capture, a pretty big range from where Google was at the time, because we wanted to make sure that we got outside of the move. And with implied volatility being high, we still got some pretty decent premium for that. Now, right now, Google is trading after hours at about 9.68, and I did an awesome Facebook Live on just this whole concept of being neutral heading into the earnings event and what everyone was thinking heading into the day, because Google was rallying above $1,000 a share. Everyone and their brother all over news and Twitter, everyone was expecting Google to have these insane numbers, and they had great like top line revenue and everything, but they had huge surprise with their basically like lawsuit, thing that they had to account for. And so that's really been crushing the stock down. And so you just never know where these things are going to go after they announce earnings, right? And so Google is a great lesson today. If you're ever on the fence about making a directional assumption with an earnings trade, don't be a guesser in this market. Just do everything neutral. But again, we went ahead and did the frontmost weekly contracts. These are the ones that expire on Friday, so they've only got 4 days to go. But selling options at 960, 955, buying that spread. So we've got a good little cushion here. Hopefully it doesn't evaporate tomorrow before the market opens. And then our calls on the top side, we'll probably just leave those to expire worthless. Those will probably not see any action at all tomorrow, given that Google's trading lower. The other one that we did squeeze in before the end of the day was CAT. So CAT was another one on our list that did also have decent implied volatility up around 72. So that was great. Went ahead with CAT and did something a little bit different. You'll notice that the expected move was about $4 or so. And so if you went out $4 from the at the money strikes, and this is the way I look at it like this. If we have the at the money strikes at 108, we go out $4, 1, 2, 3, 4, right? We're at basically like, 104 on the bottom side and about 112 on the top side. And you collect a decent premium, no doubt. You collect, about $140 or so on that, type of a spread. And that's by no means like nothing to shy at, right? But for $108 stock, the margin to do the strangle, in this case, selling the 104 puts and selling the 112 calls, just is way too much to carry. So instead, what we like to do is we like to do in cases like this, the at the money iron butterfly, where we're selling at the money around 108 and then buying options even further out around 101 and 115. And that gives us a much higher premium on this type of trade, about 393, which covers the expected move or pretty close to it. So we get about 68%, 1 standard deviation probability of success. So pretty high probability of success, fairly good risk reward ratio. So I like this type of trade. Caterpillar, unfortunately, does not announce earnings until tomorrow before the open. So we'll have to see where it's going to go before that. And obviously, Right now, it looks like it's trading just like a couple pennies higher in after hours trading, but really means nothing until the company actually announces earnings tomorrow and we see where it goes or not. And obviously, we'll give you guys guidance on that tomorrow as soon as we get an update from that. So as always, hopefully you guys enjoy these video updates. If you have any comments or questions, please add them in the comment section right below. Until next time, happy trading.